Welcome to our presentation for Texas Capital Bank versus Pacific Western Bank. We, as a group, decided to pick Texas Capital Bank and Pacific Western. They're both in the peer group 2, so we decided to go with these two. Go ahead. I had capital adequacy and liquidity, but first I'm going to talk about capital adequacy. Go ahead. So Texas Capital Bank, some things we look at when we're talking about capital adequacy as total assets, total equity, leverage ratio, and capital ratio. Texas Capital's total asset for Pacific Western's total asset. Texas Capital has grown consistently from 12 to 16% over the past 5 years, whereas Pacific Western Bank fluctuates a lot. As you see, it fluctuates from 3% and then to 2017, 14%, and then back to 3, and then 4%, and then finally 10% in 2020. Texas Capital stayed above the peer group average of growing their total assets the entire time until the last year when the peer group jumped up, but Texas Capital still consistently along the line is better than Pacific Western. They were below the entire time except for 2017. They jumped up 14% that one time. Other than that, they stayed below the peer group average. Go ahead. Texas Capital's total equity versus Pacific Western's total equity. Texas Capital consistently grows every year. If you look at Texas Capital, even though their equity is a lot smaller than Pacific Western's a bigger bank per se. So, but each year you see Texas Capital's growing each year. Even this little spot right here, they're never negative. They grow. Pacific Western increases and decreases each year, so they go up and then down and up and then down. So to me, that makes them just a little riskier on their equity. And then their capital leverage ratio versus Pacific Western's leverage ratio. So their tier 1 leverage ratio is your liabilities relative to your assets. If you look at the Texas Capital's leverage ratio, it stays below the peer group's average. So theoretically, their liabilities relative to their assets are smaller than the peer group, which is a good thing. That means they're limiting their risk in a way. Pacific Western is above the peer group average the entire time, which means they have more liabilities relative to their assets or more debt relative to their equity. And so they're above the peer group average, which isn't a very great sign, but to me it shows that Texas Capital is a little bit better at managing risk over Pacific Western. But go ahead. Then we move on to, go ahead. Is that it? Is it? Texas Capital ratio versus Pacific Western's capital ratio. Capital ratio, you want a higher capital ratio. You don't want a lower capital ratio. Capital ratio is a way to show how much cushion you kind of have for loss in your company or in your bank. So both banks are both below the peer group average, which isn't necessarily a good thing, but Pacific Western is a little bit higher, but it makes sense that they're a little bit higher because we just saw their liabilities to their assets relative to their assets was a lot higher. So of course they're going to want more cushion because they have more liabilities to assets than this bank does, than Texas Capital. But yeah, I'm gonna shoot it on over to Amy, and that was it for capital adequacy.
And now for asset quality, this is one of the most critical areas in determining like the overall condition of a bank because it does show credit risk. So we first begin with looking at the balance sheet. I wrote out the top 3 asset loans for each bank. Pacific Western, there's first real estate, then other loans and leases, and lastly commercial loans. For Texas Capital, we have other loans and leases first, then commercial, and then real estate. Pacific Western's total net loans and leases make up about 57% of the total average assets, and Texas Capital's percentage is a little higher at 61%. At first glance, you can say that Texas Capital Bank does carry more risk because they do possess more commercial loans than residential mortgage loans, and those commercial ones are the ones that tend to carry more risk. Now for liquidity and investment portfolio, I did the same. I put the top 3 securities. For Texas Capital, we have pass-through mortgage-backed, then CMO and REMIC, and then U.S. Treasury government agencies. For Pacific Western, there's first municipal securities, then commercial, then U.S. Treasury government agencies. Now for these securities, it is always best to have U.S. Treasury and government agency securities at the top because these are the ones that carry the lower risk and they make a bank look good, but neither of these banks have the security at the top, which means there is more risk shown there. Now to go into some ratios, we first have the loans and leases allowance to loans and leases ratio. This shows how much cushion exists in the allowance for loan and lease losses account to absorb losses within the loan and lease portfolio. Now, by looking at the graph, we can see there is like a similar consistent correlation going on between the two banks. But once we get to 2020, Pacific Western does take a peak, which is good because here we want a higher ratio. Now for non-current loan and leases to gross loan and leases, this ratio shows the percentage of the loan and lease portfolio that is past due at least 90 days. Here we want a ratio that is closest to zero, and Pacific Western is the one that manages to get the ratio down to zero, which means there is nearly no non-current loans, which may hurt the bank's asset quality. And now for some more asset quality ratios, we have provision for loan loss ratio, which is provision for loan losses divided by total loans and leases. This ratio shows how a bank is protected against future losses. In other words, like the expense set aside as an allowance for potential uncollected loans and loan payments. And these two have a very similar correlation as well throughout the years, but they both have very low ratios, which is not a good look because low ratios means there's more risk there. And then lastly, we have loan ratio, which is net loans and leases divided by the total assets. This ratio is used to assess the bank's liquidity by measuring the total loans outstanding as a percentage of total assets. Both show pretty high ratios, which again is about luck because this means their liquidity may be in the lower side and they may be carrying higher risk. And lastly, for the actual asset quality rating, they both are around the same ratings. We do give Texas Capital the rating of 3 because their asset quality credit risk practices are slightly less than satisfactory. And Pacific Western is right there between 2 and 3, but we'd assign it a 2 because they are a larger bank and they are performing slightly better in this category asset quality. But Texas Capital does have more room to grow and to improve. So, yeah. And now we have Gabby to talk about earnings.
Thank you, Amy. My name is Gabby, and I'll be talking about the earnings. So, when analyzing the earnings, there's 3 components you can look at. You can look at the net interest income, service income, and the trading income. Out of all 3, I decided to look at the net interest income because it's the most stable out of all. In comparison between the 2 banks, the Pacific Western outperformed the Texas Capital in all 5 years, yielding a higher ratio. In 2016 through 2018, the Texas Capital Bank had a percentage greater than their peer group 2. And so when looking at the years 2019, they both had the same percentage of 3.23. And when 2020 came, the percentage of net interest income was 14% less than their peer group 2. And I'm guessing like because of the pandemic and them being able to push back their loans, that's where the drop came from in 2020. Lastly, in Pacific Western Bank, they stayed relatively high compared to their peer group 2 in all 5 years. But when 2020 did come, they did kind of have a little drop, but not really. But in all 5 years, they decreased from 2016 to 2017. You can't really see it, but they did have a decrease throughout all 5 years. But 2020, they had a bigger drop. And next slide. And here's Zach with liquidity.
Thank you, Gabby. I'm back again. That's what I do. Let's talk about liquidity. Okay, yeah, thank you. So Texas Capital Bank versus Pacific Western Bank and short-term assets. I thought I chose short-term assets to talk about liquidity because usually when a bank's looking to be liquid, you're gonna look at their short-term assets, because that's something that they can possibly change into cash money or anything liquidated really fast to cover their liabilities. If you look, Texas Capital Bank has a lot more short-term assets than Pacific Western, which I think is a good thing, because if you go to the next slide, if you look at their total liabilities, Texas Capital has a lot of liabilities, a little bit more liabilities than Pacific Western, but since they have such higher short-term assets, they can cover these liabilities, I think, in a faster process. But Pacific Western, they have almost the same amount of liabilities, not that much more in certain aspects, but their short-term assets are a lot lower, so I feel like it'll be harder for them to liquidate their short-term assets and find a way to cover all the expenses and liabilities that they do have. But so to me, it reassures kind of the thing that Pacific Western may be the riskier bank. Both banks have, throughout the research, has been a little more, they've both been almost the same amount of risk in different types of areas. They almost average out to the same type of risk. But yeah, that's what I found for liquidity. And now I'm gonna talk about sensitivity. So I hope you like this little sensitivity. We chose sensitivity because there's a little picture in the background, so you go up and down, it was sensitive. So go ahead, next slide. So when we look at sensitivity, we know in finance that most stocks, you look at beta to determine to how sensitive a stock is to the market. So we thought we'd go to their Yahoo Finance and check out their beta as a bank, and we found that Texas Capital beta is 1.87. So that says that if the market is going up by 1%, Texas Capital will go up by 1.87%. If the market is going down by 1%, Texas Capital is going to go down by 1.87%. So it's a little bit more volatile than the market. So if the market's doing really good, bank's going to do a little bit better. If the market's doing really bad, bank's going to do a little bit worse. And then if you look at Pacific Western, their beta was 1.52, so it's a little bit less than Texas Capital, but both are considerably riskier than the market. So if you are banking on one of these banks, then if the market's doing well, both of these banks are going to do better than the market. If the market's doing worse, both of these banks are going to do worse than the market. Since Texas Capital has a higher beta, we determined that through the beta that Texas Capital could be seen a little riskier, but I don't know if that's necessarily a bad thing when your beta is that high. It could mean that you're trying to grow faster and you're trying new aspects to grow your company, and that could just mean that Pacific Western may be a little bit stale, or it's just a tad bit safer. And that's all I have for sensitivity. And now I'm going to shoot it over to Tyler for management.
Thanks, Zach. So now I'm going to be talking about management. Next slide. All right, so first we're going to talk about net income. And as you can see, both these companies had some strong net income growth prior to 2020. In 2017, Texas Capital, starting in 2017, their net income year over year was 26%, up to 50, down to 7, and then down to a loss of 76% in their net income. And then for Pacific Western, it was a 1%, 37%, down to 1%, and then down to a loss of 350%. And in 2020, this huge loss in net income can be contributed to the pandemic, and then also for Pacific Western, it can be contributed to a goodwill impairment charge. Next slide. All right, so we can talk about the average total assets for both these banks. So prior to 2018, or prior to 2020 when the pandemic started, in 2018, Texas Capital even started making strong pushes to increase their assets to start to grow their bank size. So in 2018, Texas Capital's average assets were $25 billion, and in 2020, that jumped all the way up to $38 billion. This is a 52% increase in assets from 2018 to 2020, and while the average total assets for Pacific Western was $24 billion in 2018 to $27 billion in 2020, that's only a 13% increase. So obviously, Pacific Western, even beginning in 2018, they're making some huge steps to try to increase their assets to try to increase the size of this bank. So can we just talk about the ROA? So with the managerial decisions to increase Texas Capital's assets. It allowed for lower risk and more positive net income, which helped them during the pandemic and helped them not to maintain a net income loss, which is unlike Pacific Capital, to where they weren't really increasing their assets as much. So that's why they experienced a loss during the pandemic. So in September 2021, Texas Capital announced a new strategic plan that, even coming off of their increase in assets that started in 2018. This strategic plan includes organizing around client delivery and investing in new banking technologies, expanding their products and services, which is pretty big, and including launching broker-dealer and exchange, and enhancing accountability and maintaining financial resilience. With that, one of the most important features is that they were pursuing a hiring plan that they want to double the size of their client-facing employees by 2025. So they have this massive hiring plan while increasing assets. So Texas Capital is really trying to build the size of this bank, as I continue to say. And this is different from Pacific Western, which their strategic plan since like 2015 has been about the same. And with these hiring plans and with this positive outlook for Texas Capital, like the executives of Texas Capital have bought starting in 2020, they've bought many shares. Like in Q3 of 2020, they bought $1 million worth of shares. And as you can see, Pacific Western, they have not really bought any shares. They actually sold 650,000 worth of shares in Q2 of 2021. So there's some high positive outlook for Texas Capital here in these next few years. So with all that being said, in conclusion, although Pacific Western is currently a larger bank, we have found that because of the strong growth of Texas Capital during the past few years, we feel that they have a better positive outlook and a higher chance to have better growth rates in the next upcoming years. However, with these high growth rates, that does mean there is going to be still some risk, but because there's such strong positive outlook, we believe that right now that Texas Capital Camel's rating is a 3, and it's going to increase to a 2, while Pacific Western will probably stay at a Camel rating of 3.